Many Canadians who regularly spend time in the U.S. decide to buy their own U.S. vacation home. If you are one of these Canadians, you should be aware that your estate may be subject to U.S. estate tax when you pass away. Despite the fact that you remain a Canadian resident, your estate may be subject to U.S. estate tax if, at the time of your death, you owned U.S. assets with a fair market value greater than $60,000 US and the fair market value of all your assets is greater than the U.S. estate tax exclusion amount of $5.45 million US for 2016. These amounts are subject to change, so be sure to discuss this with your tax advisor and check the IRS website at irs.gov for up-to-date information. If you determine that you have a significant U.S. estate tax exposure, you should carefully consider how to own your vacation home. Many Canadian couples want to own the property jointly with the right of survivorship with their spouse. However, depending on their particular circumstances, the property can be subject to U.S. estate tax twice. When property is held jointly with the right of survivorship, the deceased's interest in the property is automatically transferred to the survivor, which may cause the full value of the property to be subject to estate tax again upon the death of the survivor. In other words, it is possible that 100% of the value of the property may be subject to U.S. estate tax twice, once upon the death of the first spouse and then again upon the death of the surviving spouse. As a result, owning a U.S. property jointly with the right of survivorship with your spouse may not be the best option. There are, however, other ownership structures that have different tax impacts. For a married couple, putting the ownership in the hands of the spouse with the lower net worth may minimize the U.S. estate tax exposure. Alternatively, owning property as tenants in common in conjunction with some will planning may minimize the U.S. estate tax imposed on that same U.S. property. When a property is owned as a tenancy in common by a couple, each spouse has their own share of the interest in the property. Instead of the property passing automatically to the surviving spouse, the deceased's share of the property can pass to whomever they designate in their will. A testamentary trust created by each spouse in his or her will may shelter that spouse's interest of the property from being subject to U.S. estate tax a second time when the surviving spouse dies. Keep in mind, this option would only be a practical option if both owners have the funds to contribute towards the purchase of the property. Finally, U.S. estate tax may be avoided at death if the property is owned by a properly structured Canadian trust and not by an individual. Since the transfer of real property to an irrevocable trust would be considered to be a gift for U.S. gift tax purposes, it is important that the funds be transferred into the trust first before the property is purchased. There is not one ownership structure that fits all circumstances. In order to determine the best structure for your particular circumstances, you need to consider all of the tax issues, such as the application of U.S. gift tax with a cross-border tax advisor, as well as the non-tax issues, such as the professional fees associated with implementing and maintaining a certain structure, as well as the stability of family relationships, particularly if you are considering the use of a trust. If you don't already have a cross-border tax advisor, your BMO professional can help you find a tax advisor to meet your needs.